Five stocks I'm buying May 2023. Welcome back to another Stock Dads video. My name is Chris, your host here, VP of Marketing Stock Dads and one of our exclusive analysts. And in today's video, we're going to be talking about some stocks that I am personally buying in my long-term investing portfolio. The market is presenting some amazing opportunities right now, so I can't wait to share these with you guys. Let's get started. If you're new to the channel, by the way, make sure to subscribe because we do these videos every single week. Stock number one here is Perry stock, PTON Network. And if you've been following Stock Dads across social media, whether it's Instagram, YouTube, or TikTok, you know that I have been championing this stock for years. This is one of my favorite stocks, one of my largest positions in my long-term investment portfolio. And I'm going to talk to you here about why this is a huge opportunity currently that's presented in the market. So Perry stock is about a $34 stock here as of this recording, $1.5 billion valuation, trading around a PE ratio of 15. This is a company that is in ad technology, diversified in search and display. Microsoft Bing is experiencing huge growth right now thanks to the innovations with ChatGPT and AI in general. A lot of interest, a lot of eyeballs, whether it's people that are searching and of course advertisers that want to capture those eyeballs. So the more people that flock to Microsoft Bing, more downloads, you can see the results there. There are going to be more people that want to advertise, and Perry is the supplier and partner for Microsoft in that arena. But besides Microsoft Bing, Perry also has many other growth drivers for the company. Like number one, retail QR code infused ads. These are ads that allow people to just scan the QR code and immediately go to a checkout page. Very cool stuff. You also have sort cookieless technology. Everyone is going to have to move off of cookies in the next couple of years. And when that happens, I expect Perry to get even more business because its technology has actually performed better than cookies. You could see, according to its studies, 3 times better in some cases. And then finally, you have just more people in a secular trend, right? The whole world is shifting towards on-demand video and connected TV as opposed to legacy television. And we've been seeing that throughout the results over the past couple of years. The company has consistently beat earnings quarter after quarter after quarter and raised guidance many times. They just reported earnings last week with Q1 revenue growth of 16% and net income growth of over 50%. The company has no debt, and meanwhile it has over $430 million in cash. Recently, Perry stock has dropped about 25% from its high from about $42 down to a low of about $31, $32. I don't know what's going on in the short-term price action. I don't really care for the short-term price action because long-term, I think the story in the company speaks for itself. So when the market presents a gift, I'm taking it. So I've been buying more shares. Stock number two on my list is JFIN, a Chinese fintech company. Now, this company I think has been an absolute no-brainer since my last video. This has actually gone up quite steadily from about $4 per share now to over $5 per share here as of this recording. It's still only about a $250 million market cap, but the PE ratio is under 2. You're basically going to get this company for free, so the valuation just doesn't make sense to me. So I took that as a sign to just buy into this stock, and it's done well. But to give more context here, JFIN is a fintech company in China, as I mentioned. It is a lending platform. So what they do is they connect lenders to potential consumers, right, with its proprietary AI algorithms. Over the past year in 2022, they did over $400 million in revenue. They did $170 million in net income, growing its revenues by 80%, grew its net income by 150%, and their guidance for 2023 is for an additional 20 to 25% growth for its loan originations, which is a pretty good indicator of how much their revenue is also going to grow. But that's not all they're doing here to reward shareholders, because they're also doing a dividend, which is a new policy that they're going to pay out 15% of net income every year. And it's going to be split into 2 payments, so biannual dividend, and it works out to about a 10 to 12% dividend at the current stock price. And they also have a share buyback program, so they're very conscious of their stock being undervalued. I agree with the stock being undervalued, so I'm buying the stock. Of course, it's a Chinese stock, be cautious with that. But on the flip side, because it's a Chinese stock and most of its operations are in China, China's currently undergoing an economic reopening. As long as China continues to grow, I expect more people to continue to take out loans, grow their businesses, start new businesses, and this company is going to thrive. And not just China, they're also starting to expand internationally as well to other areas like Africa and Southeast Asia. So definitely a great stock to look into in my personal opinion. Hey, if you've been liking these stock picks so far, make sure to check out the Stock Dads Discord. This is where we post our trading alerts in real time. We have a team of analysts, including myself, that posts alerts, commentary, discussions. We also have live streams and video courses, mentorship program, a whole lot of value that I can't go into this video, but be sure to check it out, link in the description. Number 3 on this list is actually an index fund, and it's going to be KRE, the S&P 500 Regional Bank ETF. Controversial pick probably with a lot of people watching this because of all of the banking crisis that's been going on over the past couple of months in 2023. Now, why do I think this is a good opportunity right now? Well, many of these banks have lost some deposits over the past couple of months because of the drama, but it was actually mostly in March where most of the problem existed. And since then, many of these banks have actually regained deposits, even when First Republic went down just a couple weeks ago. If you look at the real data that Western Alliance provided with their update, they actually gained deposits after First Republic went down. And if you look at PacWest, another troubled bank, they didn't see any significant outflows after the whole First Republic collapse either. So I think that the fear has been overblown. People have PTSD in some ways with the banking sector, but I think that when people are fearful, you need to be greedy. Warren Buffett said that, and I think that's the case here. I'm gonna put on the screen a list of the top 10 stocks in this ETF. A lot of people think that there has been some market manipulation of these banking stock prices. I mean, you look at some days, these are stocks that went down 50 to 80% and got halted like 20 times in one trading session. Very abnormal behavior. And we know that the White House is looking at short selling. We know that the Fed is looking at short selling. It's a little crazy. I'm more focused on the long-term trajectory here. Many of these banks are trading at extreme fractions to their historical PE ratios, as well as their tangible book. Western Alliance, this is trading at about 1/3 to 1/4 of what I personally believe it should be trading when you compare it to historical averages. The risk to reward is far too high, right? It's just too cheap to ignore right now with these regional banks. On a similar note, stock number 4 is going to be Schwab stock. I've proclaimed myself Schwab daddy. So I started the Perry Pals fan club with stock number 1 Perry. I am the Schwab daddy in stock number 4 Schwab. So this is about a $47 stock here as of this recording, $80 billion valuation. This company has over $7.6 trillion in client assets, and people want this company to fail. People think that there could be a bank run. I think that is kind of stupid, right? It just doesn't make sense. You're ignoring the fact that this is primarily a financial services company with stock trading, options trading, just retirement account investing, wealth management services, for the wealthy clients. One valid concern about Schwab is that they have seen cash move from sitting idly in brokerage accounts and deposit accounts into money market funds that do pay a higher interest rate, because then Schwab loses a source of money, a source of funding that they could use when they're doing their lending. And that this whole thing affects profitability. But they've seen that trend of people moving money around slow down month to month to month to month. This company just had record earnings in Q4 of 2022, and they followed that up in Q4 with another solid set of results, about 10% revenue growth and about 15% net income growth. Looking at the valuation, once again, similar to all those regional banks, this is trading at a fraction of what it should be. If you look at the 5-year average PE ratio, this should be at approximately a 22 PE, and at one point was as high as 36, 35 PE. Now it's only trading at about 13 PE, 14 PE. Are you kidding me? So I think that this is definitely a great opportunity to invest into a long-term proven business at a low price. And finally, stock number 5 is actually another index fund, and it is the QQQ Invesco NASDAQ 100 Index Fund. This is an extremely safe pick. Yes, this is your traditional technology ETF. It's made up of a lot of different big tech companies like Apple, Microsoft, Amazon, Netflix, Google, Facebook, or Meta now. There's a lot of potential here for growth in the future. In the previous bull market, big tech led the way higher. If you look at the recent results with their earnings, Companies like Apple, companies like Meta have performed extremely well. Why? Because they've now all focused on profitability. Revenue can grow relatively slow, 5 to 10%. But if you're cutting costs like crazy, because frankly, you have a lot of workers that don't do anything, they just, sit at home and play games while they're supposed to code, right? That's gonna increase your net income, bottom line. Layoffs are the most bullish thing that happens to Wall Street since the past couple of years with stimulus checks, right? Because people are expensive. And many of these companies, after announcing layoffs, their stock prices bottomed and they've been going higher. So there you guys have it. Those are 5 stocks I'm buying in May 2023. Perry, JFIN, KRE, Schwab, and QQQ. If you like these stock picks, make sure to give this video a big like. And remember to subscribe. We do these videos every single week. Hope you guys enjoyed it and got a lot of value. I'll see you guys in the next video. Good luck investing and trading in the stock market.